Welcome to the deep dive. Today, we're doing a deep dive into the one metal that's, well, it's all over the financial news: gold. It's hitting all-time highs, which is strange for an asset that's been around forever. So we're really focused on this paradox of why this ancient metal is suddenly more relevant now than it's been in 50 years.
And that price surge,
Yeah.
that's the signal, right? It's a direct market reaction to uh, crumbling confidence in the global financial architecture.
The whole system.
The whole system. I mean, look at the explosive growth of national debts, not just here, but globally. And when the U.S. dollar, the world's reserve currency, is actively used as a weapon, as a tool of geopolitical pressure, people start looking for a safe harbor.
They need something tangible.
Exactly. They're searching for tangible assets, for wealth that isn't just a digital promise on, someone else's balance sheet.
So that really gets to the core question for you listening at home. Why should you care about gold right now? We're going to unpack the fundamental economics driving this whole thing. We'll also reveal some performance facts that the mainstream media just seems to ignore, and this is critical. We're going to expose the dark, predatory underbelly of the precious metals market, the scams that target everyday people.
To really get why gold is the default in a crisis, you have to go back to first principles. I mean, what makes anything function as money in the first place?
Okay.
It needs 6 specific, pretty rigorous characteristics. It's got to be durable, portable, divisible, fungible, meaning, 1 ounce is the same as any other ounce, easily recognizable, and maybe most important of all, it has to be scarce.
That's a really demanding checklist. If you were to scan the entire periodic table of elements, how many actually meet all those criteria well enough to be, ideal money?
Well, really, only 2 elements truly fit the bill: gold and silver. They have these intrinsic characteristics that just let them function perfectly as both a medium of exchange and an incorruptible store of value. When you buy gold, you're eliminating what we call counterparty risk. You hold the actual asset. You don't need a bank, you don't need a government, or any third party to say it exists or has value.
The history of it is what I find almost metaphysical. It was adopted independently as money by civilizations that were completely separate: the Egyptians, the Mayans, the Incas, long before they ever had contact with each other. It sort of suggests its value isn't just a historical accident, it's almost baked into reality itself.
It really is. It's the natural alternative to what we have today, which is artificial money creation. When governments and central banks create inflation, when they artificially create credit, it is, economically speaking, it's a form of deceit.
Yeah.
It allows certain entities to get purchasing power without having produced any real wealth or value.
Let's break that down, because you mentioned this aha concept here, the first mover advantage. How does that wealth transfer actually work?
It's a stealth wealth transfer. Think about it like this. If a central bank suddenly injects $1 trillion into the system, who gets that money first?
The big banks.
Financial institutions.
The financial institutions, politically connected entities, exactly. They're the first movers. They use that brand new money to buy assets, stocks, real estate, commodities at the old prices, before that massive flood of money has had time to circulate and push all the prices up for everyone else.
So they're buying assets cheap with money that hasn't fully lost its purchasing power yet.
That's it, precisely. By the time that money filters down to the average person, market signals have already sent consumer prices way higher. Gas, groceries, rent. The average person is left holding currency that's depreciated, paying higher prices, while the first movers have already locked in their gains. That is the fundamental, quiet power of fiat money, which just means by fiat, simply I say so. It's based on a decree, not real value. And this skepticism of fiat is why, in a lot of mainstream circles, gold gets mocked. It's for the dummies, right? Or the tinfoil hat crazies who think society is always on the verge of collapse. But we really have to challenge that with cold, hard data.
Oh, that narrative that gold is a dusty, boring asset is just demolished by reality, especially over the last quarter century. We looked at the performance data from January 1st, 2000 until today. Over that 25-year period, physical gold is up over 1,000%.
1,000%. That's a massive return. What was the main driver of that? Was it the 2008 crisis, or was it more of a slow burn?
Well, the initial gains were driven by instability after the dot-com bubble burst in 9/11. But you're right, the 2008 Great Financial Crisis was the real catalyst, when the U.S. government started massive quantitative easing, basically. Printing money to bail out the banks, investors just flooded into gold. They correctly saw it as a hedge against currency debasement. It was a huge wake-up call for a lot of people.
Okay, so now compare that 1,000% to the standard benchmark, the S&P 500, over that exact same 25-year window.
Even if you include reinvested dividends, the S&P 500 is up less than 400%.
Yeah.
The takeaway here is just stunning. If you had put your assets into gold 25 years ago, you'd be more than twice as rich as someone who just followed the standard advice and stayed in the stock market.
So the obvious question becomes, if gold has outperformed the stock market by such a shocking margin for 25 years, why is this fact so aggressively ignored? Why don't we hear about this in the mainstream financial press?
Because it's a deliberate, long-standing policy objective of the United States government and the Federal Reserve. They actively discourage the use of gold and try to suppress its price relative to the dollar.
And what's the purpose of that suppression?
It's all about maintaining dollar dominance globally. That reserve currency status has allowed the U.S. to export its inflation, to live far beyond its fiscal means, and to finance its massive military presence all over the world. Gold serves as a direct, unmanipulable barometer of the dollar's health. So if the gold price is allowed to just rise freely, it signals a deep weakness in the dollar, and that threatens the entire system of U.S. global power. But this dominance, which has been the bedrock of world trade since the 70s, it suffered a potentially fatal blow back in 2022.
And you're referring to the unprecedented sanctions placed on Russia after the invasion of Ukraine.
Precisely. For the very first time, major U.S. Treasury debt held by a sovereign nation was seized, it was immobilized. And that action revealed a really hard truth. The dollar is no longer a neutral reserve asset. It sent a message to every other country holding U.S. treasuries, even friendly nations, that if you ever cross Washington, your assets can be frozen or confiscated.
So in an attempt to punish one country, the U.S. basically threatened the entire global system of trust that the dollar was built on.
That's it. It was a monumental strategic mistake. It instantly triggered widespread de-dollarization efforts, especially among the BRICS countries. Brazil, Russia, India, China, South Africa. They all started urgently looking for an alternative, a neutral reserve asset.
And of course, some pundits immediately pointed to alternatives like Bitcoin, but you have a counter-argument on whether it's actually viable for that role.
Bitcoin is a brilliant technology, no doubt, but it faces some severe challenges as a global reserve asset. I mean, leaving aside the security and scaling issues for a moment, it relies completely on electricity and the internet. If you have a major grid failure, or if you consider the vulnerability to something like an NMP attack, the entire infrastructure that supports AI and crypto, it's transitory. It can vanish.
Which brings us right back to gold, the ultimate physical asset, as the solution to these global trust issues.
Gold is, in a lot of ways, the original cryptocurrency.
Yeah.
It's decentralized, it's recognized globally, and it's linked directly to your own individual sovereignty. I mean, consider its physical properties. $1 million worth of gold, at today's prices, weighs only about 35 pounds. You can carry millions in actual wealth in a small briefcase.
That portability is incredible, but beyond just being able to carry it, what about privacy? Especially for high-value transactions.
It offers unparalleled privacy and financial freedom. If you buy or sell certain forms of gold, specifically the U.S. Gold Eagle coin, it is actually exempted from 1099 government reporting requirements.
Okay, let's pause on that because that's critical jargon.
Sure.
What is 1099 reporting in this context?
A 1099 form is the standard IRS notification that's required for large financial transactions, usually anything over $10,000. It flags the transaction for federal review. But because the U.S. government itself recognized the Gold Eagle as actual money, large private transactions, even $1 million or more, can be done without that federal notification. And beyond that, globally, nations treat gold as money. Most international trade gives it favored treatment, meaning no tariffs, no taxes on importing pure gold, because it's not seen as a commodity, it's seen as currency.
And one final thing, let's just smash this misconception about durability. If your house burns down, what happens to that wealth?
Gold is incredibly durable. It's fire resistant. If your house burns to the ground, the gold will just melt into a dense recoverable slag. It doesn't vaporize or burn up like paper or, digital assets. You might lose maybe 2 to 5% for refining, but it's fully recoverable. It is wealth crystallized physically, it's delivered, and it eliminates counterparty risk completely.
Now, we have to address the unfortunate dark side of the surging market. Because when prices soar like this, the predators come out. You mentioned that major media personalities have been offered huge sums, I think in one case, nearly $20 million a year, just to market these products. That enormous marketing cost, it has to be paid by someone, and it's paid through predatory pricing.
That's absolutely right. The scam is massive, and it targets retail investors, often older people who are relying on retirement accounts like IRAs. These companies are ripping people off by selling them gold for 150%, sometimes twice its actual spot price or even more.
How on earth do they convince people to pay double the recognized commodity price?
The tactic is, it's misleading. They sell what they call commemorative coins or special issue coins, often with really fancy packaging, and they claim these coins have collector value far above the actual bullion weight. They try to confuse the customer into thinking they're buying some kind of rare antique. But in 99% of these cases, gold is a commodity. Its value is determined purely by its weight, not the picture of an eagle or a president stamped on it.
So let's picture a typical victim. Someone using their retirement savings, they think they're buying a hedge against inflation. What's the real consequence when they try to sell that metal later on?
The consequence is disastrous. Let's say they bought a gold coin for $3,000 when the actual spot price was $2,000. So they paid 50% over spot right there. Even if the price of gold goes up by $500, they are still underwater. They've lost money instantly. And when they try to liquidate, the dealer just buys it back at the real spot price, guaranteeing the customer takes a massive loss.
So this all boils down to transparency and ethics. An honest dealer operates with very low markups, usually 1 to 4% above spot, just to cover friction and overhead.
And that leads to the one key metric every single listener needs to know. The spread. The spread is the difference between the dealer's selling price and the repurchase price. That spread is the true measure of your transaction cost. Scammers have spreads of 40% to 100%. An honest, ethical deal should be in the 3 to 5% range.
And what's the legal loophole that lets this predatory behavior thrive, especially in the retirement market?
It's the lack of regulation. There is currently no requirement for sellers of physical metals into retirement accounts, like gold IRAs, to act as a fiduciary.
Can you just quickly define fiduciary in that context for us?
Sure. A fiduciary is a legal standard, usually for financial advisors, that requires them to place their clients' best financial interests above their own compensation. Because these metal sellers are not required to be fiduciaries, they are legally allowed to recommend the product that earns them the highest commission, whether it's a good deal for the client or not. That lack of duty is what enables the entire scam industry.
Let's briefly shift over to silver because it's often purchased alongside gold, and it highlights just how distorted these markets can get.
The silver market today is showing a massive disconnect. Historically, the gold-to-silver ratio, so the number of silver ounces you need to buy 1 ounce of gold, was around 12 to 1 to 15 to 1 for centuries. Even the ratio of what's naturally mined from the ground is only about 7 to 1 to 10 to 1.
And what is the current ratio today? How many ounces of silver to 1 ounce of gold?
It's hovering around 90 to 1. 90. This discrepancy is immense. It just defies natural supply dynamics, which suggests that silver is highly undervalued and probably subject to market suppression because it's both a monetary metal and a critical industrial metal.
And this manipulation, it all ties back to the fundamental problem we talked about earlier, the fiat system. The U.S. government officially defaulted on the gold standard in the early 1970s.
That moment, 1971 to 72, is arguably the brightest line in modern human history. It marks the precise beginning of the steady, grinding decline in the purchasing power and the stability of the American middle class. That system unleashed forces of debt creation and wealth transfer that were just impossible under a gold-backed standard.
Which leads to this staggering hypothetical. The U.S. government, on its own books, prices its gold reserves at $42.22 an ounce, thousands below the market price. If the system were ever forced back to an honest standard to actually back the current money supply with its gold reserves, what is the theoretical revaluation of gold?
Well, financial analysts who track the U.S. money supply, specifically the Fed's balance sheets, they calculate that to fully back all the existing U.S. currency and debt with gold, the price would have to revalue to somewhere between $20,000 and $40,000 an ounce. And that astronomical number, it just illustrates the depth of the currency debasement that's happened under this fiat system.
Which brings us full circle. Fiat money creation isn't just a benign policy choice. It's the root of so many societal problems. It enabled unpopular, unfunded wars, and it made the massive offshoring of our industrial-based globalism economically possible, no matter what the people wanted.
Absolutely. Removing the gold standard removed the governor on financial irresponsibility. Gold, on the other hand, it isn't just about profit. It's about control. It's about sovereignty. Its value isn't just in dollars. It's that it eliminates counterparty risk. It is actual final wealth that cannot be inflated away or seized digitally.
So the key lesson here is that to get true financial freedom and privacy, you have to do your homework. It means understanding the mechanics of money, its history, its incredible outperformance, and the political systems that are designed to suppress its importance. And we'll leave you with this one provocative thought. If the world's most powerful central banks, The very people who built and control the financial system we have now are net purchasing massive, record-breaking amounts of physical gold, preparing for a potential revaluation event. What does that tell you about the long-term safety of paper assets?